Hi everyone, my name is Omar and welcome to this month's monthly commentary. After the holiday season, the expectation was that the market was going to cool off in January. That didn't happen as the market kept rising. Here's a few things that helped steer the market. Despite a dip at the end of January after the Fed signaled that rate cuts were not imminent, the US and Canadian equities continued to post gains, to start 2024 in the green and post the third straight month of gains. Also in reaction to the Fed signaling that rate cuts aren't as close as we imagined, bond yields have come down from their peak, which was the highest level since 2007. Microsoft has become the second company to reach a $3 trillion valuation. This has been fueled by its investment into ChatGPT maker OpenAI. US Q4 data, released in January, highlighted again the resilience of the US economy. The US economy grew by 3.3% during that period, seemingly unaffected completely by the rate hikes. Usually when rate hikes happen, we expect that the economy is going to react by contracting. The US continues to grow, continues to add jobs, and is extremely resilient to the rate hikes. Another thing to note with regards to inflation in the US is that CPI increased 0.3% to 3.4%. This is still significantly down from the 9.1% that we achieved in 2022, which is suggesting that the Fed might be a little bit closer to achieving a soft landing in the US. As a result of that, the Fed held rates at between 5.25% and 5.5%, with Fed Chair Jerome Powell saying that inflation needs to come down before there are rate cuts. Canadian CPI, which is the Consumer Price Index, which is a measure of inflation, rose from 3.1% to 3.4%. Consistent issue remains to be shelter and housing. That's a big driver for inflation in Canada. I know a lot of Canadians are feeling that at the moment. They feel they're priced out of the market and priced out of buying a house, and that remains one of the biggest drivers of inflation in Canada. Due to that, the Bank of Canada has opted to keep rates steady at 5%, with Bank of Canada Governor Macklem stating that once the economy behaves in line with the bank's expectations, then the future discussion will be about rate cuts. So how will this affect your investments? Slowing global growth, cooling inflation, and central bank policy are going to be the main drivers for financial markets in 2024, one way or the other. The remnants of rate hikes from 2022 will present a challenge in 2024. Interest rate hikes tend to operate in a lag, and it will take 2 full years for the full effects of the rate hikes to be felt in the economy, and that will definitely be a challenge in 2024. The timing of rate cuts in Canada will depend on when we can move towards a 2% inflation target. 2% is the long-term inflation target set by the Bank of Canada. On the bright side, however, there's little reason to expect a severe economic slowdown. And once we move towards that 2% inflation target, cutting the rates should help kickstart the economy. Regardless of where we're at in the market or economic cycle, it's important to stay focused on your long-term goals, which helps keep emotions out of investing. This concludes this month's market commentary. If you'd like to get more information, visit the link in the description. We also post regular market updates and finance articles, so make sure to check those out. If you like this video, please give it a thumbs up. Thank you for watching.